Let's talk about a trading strategy that is, for lack of a better term, stupid simple. Okay? And this strategy is called box theory. And it's just this simple. Take any trading day. In this case, we're going to look at this white zone here represents the New York session. And that's what we're going to focus on right now on the micro Bitcoin futures. Okay? So take any trading day. In this case, it's Thursday, June 26th. All we're going to do is, before we start the next trading day, in this case, Friday, June 27th, we're going to go back to the day and we're going to put a box around the high of the day and the low of the day. I'm going to shade that a little bit lighter so it's not quite so... Actually, you know what? That's fine. Okay. And here's the idea. When you see this low day here, you need to think to yourself, okay, this point on the chart, this level of 107,260, represents the point in the price levels that there are more buyers than anywhere else. That's the only way that it could have reversed so strongly at that exact point. Same is true for sellers up here. This point up here at 108, whatever it is, 4 and 505, represents the point on this chart on this day that there were more sellers than anywhere else on the chart. And we're not talking about retail sellers either. We're talking about big players, institutions, hedge funds, banks, family funds, big money. Okay? So just keep that in mind, that there were more sellers here than anywhere else on the chart that day, more buyers here than anywhere else on the chart that day. Now, history does sometimes repeat itself. It doesn't always, but it quite often does, and especially in trading and especially at low a day and high days. So here's the theory. The theory is that your job as a trader is to give yourself the highest probability chance of success every time you click that buy or sell button. And to do that, you need to be trading with the big players, not against them. Everything they're doing in their day-to-day is designed to get you, the retail trader, to do the wrong thing. To buy high, to sell low, to buy high, etc., etc. And how they do that? They trick you. They shoot price down. They push price down real hard, real fast, with lots of volume, okay, to entice you, okay, to get involved in the direction that you think the price is going in, right? So if they put a bunch of volume in on the downside, they're trying to get you to join in, either sell what you already bought or to short or start a fresh short. But what they're really doing is they're trying to get your contracts at low price so they can just bounce it back up and make a profit. And that's basically all that happens all day, every day, day in, day out. And why it's not more obvious to more people, I think I know why. Human nature. Human nature is we see a trend, we want to join that trend, okay? And it's also very difficult, I guess you could say, to pick a bottom. And, we're kind of taught also, hey, don't try to pick bottoms. It doesn't usually work too well. You can't catch a falling knife. You cut your hand off, etc. Join a trend, okay? So basically, they're trying to entice you into joining that trend, and they're just going to turn around and do a rug pull every time. So your job is to look back on the prior day when a new trading day occurs, and in this case, it's 8:30, 9 o'clock in the morning on Friday. Your job is to look back, put your box in, okay, and then look for setups that are designed to let you be a buyer at the lows and a seller at the highs. Now, if you had to choose between being a buyer and being at the lows and a seller at the highs, I say go back and look at the daily and the hour, maybe the day, 1 day and 4 hour charts, and kind of get a feeling for what's the big trend. Because that'll really help you choose the right direction. And they're both probably correct, selling the highs or buying lows. But one of them is usually a little bit better, and so why not align yourself with the one that is? So, in looking at Bitcoin here, I mean, in 2025, you know, we were going up the first part of the year. We pulled back during the whole tariff thing, and then after that, we've been basically on the upswing. So, you know, I'd be long biased. All right, let's go back to this. All right, so now here we are at 9 o'clock in the morning, 8:30, 9 o'clock in the morning. New York's about to start, and you know, sometimes the best trades are really during the first hour because there's the more volume then. Trends are stronger, longer, they're more sustained, volume's better, price action's a little bit easier to read. Candles, you know, form in more obvious ways. So there's less chop. So, you know, I was just going to recommend to you that get your trading done early. You know, get it done in the first 30, 60, 90 minutes of the day and just be done. Because that's going to be the easiest trades and the lowest risk. Okay? Best chance of success. And in trading, you got to stack the odds in your favor. You just got to do it. All right, so let's look at what happens on a 5-minute chart real quick here at the New York Open on Friday, June 27th. Keeping in mind that we're long biased because the overall general trend is up, right? Especially lately. And why try to, you know, counter trend trade? It doesn't make a lot of sense. So we're looking for longs. So here we go. Price action begins. And right away we see selling happening, okay? They bounce it a little bit pre-market here. It's not quite 9:30. It's 9:25. It's 9:30. Okay, here we go. Boom. Now, I'm going to stop for a second here. It's happening too fast. What did we have? We had a huge red candle breaking the lows. But then the very next thing you see is a buyer's wick with a long bottoming tail holding the lows of when? Thursday, right? Look at that beautiful candle right there. You've got positive MACD. You've got a buyer's wick here that starts at the lows of Thursday, dips down, and immediately gets bought right back up and finishing higher. So, you know, I don't know about you, but to me, that's a very viable candle. So had you bought it and traded it back to the middle, because remember, the middle is the don't diddle with the middle zone. You know, you want to buy the lows, sell the highs, but do not have any kind of bias when it comes to the middle because it's neutral territory. That's a good place to get out of a trade, okay? So had you bought this one here, 107.355, you could have taken it right to the middle up here, 840, 850. That would be worth about 500 points, which on like say 25 micros, for example, it'd be about $1,000, maybe a little bit more, $1,200. So that's basically what I want to show you. It's not complicated. It's extremely simple concept, and your job is to just know where these levels are just by marking them. It's nothing complicated about it. Just draw a box, you know, before the market opens, and then watch for those levels, those points of interest to be traded. And you see something like this with a massive buyer's wick ending green on a 5-minute candle with your MACD, definitely like hooking up to the upside here. You know, that's pretty much a buy for you. You can get long here. Place your stop under the wick if you like. It's already faked out a lot of people down here. And by the way, when you see a wick like this, you can basically believe that there were a lot of uninformed sellers all the way down, and then the smart, you know, probably emotional, and then the smart money, the calculating, analytical traders, the ones with money behind them, bought it right back up and then took it all the way back up to the middle where they sold out their positions and made a nice healthy profit and called it a day. Yeah, this trade went about 1.4, which is really nice trade. That's all I'm going to say for right now. I'm going to call this a day right now and just leave you with that.